We have a next topic, that is diversity and growth. That is lessons on managing a successful portfolio. It is presented by Mr. Kamal Kothari. He is an investment trainer. Without wasting time, without taking much of a time, Mr. Kamal, over to you.
Thank you, ma'am, and thank you, everyone. Good afternoon to all the people present over there. Uh, Really, I feel very great that I'm today amongst so much esteemed people talking about investments. So I'll just give briefly my thoughts about what the past fee. So first of all, one very big thing that we have learned is long term. What I mean for long term is that most of the people are trying basically to time the market, but instead of timing the market, we should stay sufficient time in the benefits of compounding of return, which is very much visible once the market recovers. Incremental returns I can get from my investment, I should equally be concerned that based upon my risk profile, what exactly I should allow myself to get exposed to different kinds of equity, because at the end of day, capital protection is imperative rather than just chasing the return. So this particular thing has taught us that people who don't have significant risk appetite, they should refrain from equity, or they should have a lesser exposure, but they should not burn their fingers when the market starts melting down. Third important thing is that while picking up sectors or companies or different types of themes or mutual fund scheme, important thing to note is that digitization is the future. So people or companies that are investing heavily into digitization, these kind of businesses are going to pay significantly in the long term, and one should have that ability and knack to figure out that what are the companies which are heavily invested into digitization, who have their vision and mission statement oriented towards digitization, and we should be focusing in building a portfolio who are oriented towards such kind of concept. Last but not the least that I have learned is people, businesses, small, big, medium size, all those entities that have survived during the 2020 pandemic and during the ongoing, you can say that geopolitical risk, which has thrown a lot of inflation around the world, these particular businesses are going to thrive in future. So we can say that stronger businesses will become more stronger, and even the smaller and the medium sized businesses which had the capability to survive during this wherewithal, during this turbulent time, are definitely going to reward the investors once the sentiment improves, once the consumer spending improves, once people start getting confident about the economy, and the discretionary spending also shoots up. So I always believe that big or small business, just focus who have the power to survive during the turbulent time, because when the time is good, so we say that the rising tide lifts all boats, but it is only in turbulent times that actually the test comes, that which is the good company or which is the good business model for the future. One more important thing that I have learned during this particular past time is that most of the people who were investing earlier had a transactional type of attitude. What I mean by transactional type is simply that people were investing with a core objective of maximizing returns from the investment, but that would be no more applicable, and people are going to adopt a new theme in coming days that is based upon their goal planning. What are their goals? They are going to orient their asset allocation, so that will help them not only to mitigate risk but also to achieve the goals, and thereby tiding all kind of volatility which comes in the way of wealth generation of future. Apart from this, I will also talk little bit about that basically when we say about the portfolio, how we should try to create or manage our growth portfolio. First of all, when I say that what is a growth portfolio, it simply means that when we are picking certain companies from certain sector which are basically reaping extraordinary profit, and they are reinvesting those profit either for their future expansion or for acquisition within the same sector, or might be they are building some core competencies like expanding the technology or investing in R&D. So we can say that these companies are the growth companies. So growth companies over long term have definitely good, you can say, they have good muscle, financial muscle, where they can grow exponentially as compared to their counterparts. And one should, if they want some extraordinary returns or some significant outperformance vis-a-vis benchmark, then one should have certain growth stocks in their portfolio. What are the key things that I should keep in mind while doing a portfolio oriented towards the growth stock? So first, very important thing that I have seen people committing a common mistake. People sometimes, based upon their experiences, knowledge, wisdom, and picking up good stock. So picking up a good stock is not a very big deal based upon a lot of data which is going on the net and a lot of scholarly articles that are available. We can definitely cherry pick the stock which is belonging to a growth sector. But the most important thing is that we should not chase profit very quickly. We should let the run happen completely. It is said that 80% of the effects happen from 20% of the causes, and that causes should have to play out. We should not be in a too much hurry to book the profits. Instead, we should be keenly watching that when the wealth generation is happening, and we should wait till that time. So during this particular time, it could be a very testing time. It is a very testing phase. I've seen that many people get bored, they just get completely run out of their patience because the stock doesn't perform in the short term, and but in the long term, it gives you the return for waiting patiently during that time. One of the classical example is Reliance Industry. I hope if somebody is chasing the market, they must be knowing that few years back, Reliance Industry was stuck in a particular price band from 800 to 1200 range. And people used to say that the story of Reliance seems to be over. And during the COVID time, when rest of the market has taken a huge beating, it was Reliance that has shown significant outperformance. And now everybody is betting upon that stock. So I am not here to talk about the stock specific story, but what I want to say is that during this journey, when you pick up a growth stock with a clear cut vision, good management, good corporate governance, having digitization in place, good cash flows, there can be certain times which are testing. Market is still not ready to reward this particular company, but yes, if you hold it for a long term, definitely you will be rewarded for waiting during that particular time period. So what I would be focusing much upon for building a growth portfolio, basically strong fundamentals. There are a lot of return ratio, like return on equity, or I could say like what is EV to sales, or I can say that which is the company which is generating better cash flow, free cash flow. So whatever fundamental factors looks favorable to me, I would look upon that. One of the very key parameter that I personally always advocate among my investor is that while picking a stock, just try to understand whether promoters have a significant holding in their own company. If promoters have a good holding, say like 70-80%, that speaks that they are very interested in running their businesses, because ultimately the profits are going to go in a major way to them only. So they will be interested in running the business more efficiently. So I would be placing a lot of thrust on dividends, on the promoter track record, on the corporate governance, and the promoter holding in the company. Last but not the least, despite having a growth portfolio, I would always be focusing that my portfolio should be well diversified. So when I say well diversified, it does not mean only within equity as an asset class, even among other asset class across the sectors. These days, it is possible even that you can spread your portfolio across the economy, and you don't have to do much sitting in India. You can just have access to global market either through ETF or even by through direct investing across market capitalization and across various themes. So based upon these factors, I can diversify my portfolio. It is said that if you don't diversify, basically you land in trouble, because ultimately there is always a stock specific risk. You must be knowing that. And secondly, if you over diversify your portfolio, then we say that it is diversification, means your portfolio can become a worse because you have overly diversified. So there is a very strong balancing act required, where ultimately you can spread your risk, where you decently diversify your portfolio and you wait for the time to play out. Because right now you can just say, I'll just talk with an example. I always have a that particular habit of talking with example. In 2020, we have seen that people who played out defensives like FMCG and pharma, those sectors played out very good in run up after the COVID recovery. These days, we keep on listening from many people that if economic recovery has to happen, and since a lot of time the banking sector has not grown, might be this is a time that the banking or the financial theme or the insurance sector theme can catch up. So what I want to say is that you should always be diversified. You never know which sector will go on the forefront and get you the maximum return. It's better that you keep yourself diversified across geography, across sectors, across themes. So this is all from my side. If there is anything, I would be more than willing to answer that. Any questions from the panel or anyone?
Thank you so much, Mr. Kamal, for sharing your views on managing the successful portfolio. When we're talking about the diversification, we have a very nice poll coming up. I request viewers to please, answer the poll. Can we have the poll, please? Where do you invest your money? Is it fixed deposit, tax saving schemes, small saving schemes? Is it mutual fund, shares and stocks, gold, real estate? Now this is Investors Meet. This question is very interesting and we are getting answers. It's very nice to see the response. Where do you invest your money? Mutual fund, shares and stocks, FD, tax saving, small saving, gold, real estate? No answer for gold. Okay, gold is increasing. I request more people to please do the polling so that we can have the answers and we can know what most of you are thinking and investing your money. I think it is mutual fund, which is around 67%, shares and stocks 26%, fixed deposit 4%, gold 2%, real estate 1%. Interesting.
The result shows that might be it has come from the younger generation. That is the reason, because they are not that risk averse as normally people from middle age or a higher age group, they are more risk averse.
Yeah. So I think mutual fund majorly. Thank you, team, for the poll. Thank you so much, Mr. Kamal, for being present on the forum and sharing your views on managing the portfolio. Thank you so much.
Thank you, everyone. Thank you, ma'am.
Reach out today and let's do it professionally.